Okay, welcome back everybody. What we're gonna do now is we're gonna move forward to page 927, dealing with bond pricing. Now, bond pricing, when you're selling a bond either at a premium or a discount, we're gonna get into what a premium and a discount is in a second. Okay, so if you're following along on the slides, we are at slide 24. Okay, so again, we're gonna skip over issuing bonds between interest dates. That's on page 925 and 926. The reason for that is, we only have a limited amount of time, and I gotta pick the most important topics. So let's get back to the topic of bond pricing. So with bond pricing, the issue price of a bond equals your present value of the future cash payments, but we use the market rate, not the coupon rate or the bond rate or the stated rate. It's of the market rate. So just remember, when we have a bond, okay, we're gonna buy a bond, the bond price face value might be $1 million. Okay. Now, at the end of the bond's term, we're gonna get back that $1 million, but depending on the bond contract, okay, we're gonna get an interest payment as well. It might be quarterly, it might be semi-annually, which is twice a year, or it might be yearly. So we're also gonna get interest payments. Okay, all right. So what we need to do is, when we're figuring out how much cash we're going to receive from this bond, we need to read the details in the bond. Okay, so when we're recording what the bond price is, okay, the bond price, okay, it equals the present value of the principal, or the present value of the bond, plus the present value of the cash interest payments. Okay. All right, so the next step then is to figure out, okay, well, what are these present values and how do we determine that? Okay, so let's look at the example in our textbook, okay, and this is on page 927, okay? So Fila Corp, I don't even know if they make Fila clothes anymore, but whatever. I'm just going to erase this here. Now, guaranteed a question like this is on the exam, okay? So let's look at how we deal with a bond discount. So Fila Corp announces an offer to issue bonds on December 31st, 2020 with a $100,000 par value. 8% contract rate with interest payable semi-annually and a 3-year life, okay? So what we gotta do is we gotta say, okay, well, the present value of the bond, or no, sorry, not the present value, but the face value, okay, in this case is $100,000, okay? Now, what's the interest payments gonna be? Well, again, we were told that the contract rate that's attached to the bond, or the bond's interest rate, is going to be 8% annual interest. Okay, so 8% annual interest. Okay, so we're going to get 8% per year on this $100,000 bond. Okay, so 100,000 times 8%, we're gonna get $8,000 per year in interest. Okay, but you gotta remember, okay, the interest is payable semi-annually. So we're actually going to get $4,000 every 6 months, okay? So our interest payments are going to be $4,000. Okay, what's the term of that bond? Well, the term of that bond is 3 years. So as a result, okay, our payments are made semi-annually. That's twice a year. Okay, so as a result, yeah, sure, we get an annual interest rate of 8%, which is $8,000 a year, but it turns out because we're getting paid that $8,000 per year in interest every 6 months, or sorry, on a half-year basis or semi-annual basis, is really we're getting paid $4,000 per 6-month period. Okay. So if you want to ever figure out your semi-annual interest payment, okay, you have to take your yearly rate divided by 2 times the principal. Okay. So now what? Well, we're not done yet. Okay. So from there, we know the face value now, and we know our semi-annual interest payments. So what we want to do now is, okay, what's the bond rate or the contract rate that's attached to the bond, and what's the market rate? Well, in this case here, the bond interest rate is 8%. Okay, the market rate is 10%. Again, these are both on a yearly basis. So when we do comparative purposes and we're doing our question, we have to convert each to a semi-annual rate. So this will be 4% every 6 months. This will be 5% every 6 months. Okay. And remember, that 3-year term is going to give us 6 interest payments. Okay. So from there, how do we figure out the present value of the bond, which is $100,000, and the present value of our 6 $4,000 interest payments? Well, we know right now, just from the information given, okay, that this bond is going to sell at a discount. Okay. Why is it being sold at a discount? Because the market rate on a yearly basis is 10%. We're only offering 8%. Okay. So we have to sell it at a discount because our bond rate is less than the market rate. Okay. So the only time you're ever going to use the bond rate is to calculate what you're paying in interest to the bondholder every 6 months. Okay. That's it. Now we got to go back and we got to figure out, okay, we're going to make 6 payments of interest. Okay. And our market rate on a semi-annual basis is 5%. Okay, so now what? Okay. Well, from there, we got to use our present value tables. Okay. So what I would like you to do is go into your textbook on page 960. Okay, we have our present value tables. I'm just going to move this up here. Notice table 14A1. This top present value table. This is where we're going to use, okay, our 6 periods, our 6 payment periods. So we'll go down here to 6. We go across to 5%, and we get 0.7462. So again, the top table is used to figure out the present value of your principal or the present value of your bond. The bottom table is used for your interest payments, to figure out the present value of your, in this case, 6 interest payments. Okay, so we're going to go down here. We have 6 periods, 6 payments across to 5%. Okay, and we get 5.0757. So now what we can do is we can multiply this, okay? So $100,000 times 0.7462 is $74,620. Okay. Our interest payments are going to be $4,000 times 5.0757, okay, to give us $20,303. Now we're gonna add up this, and we're gonna add up this. We get a total of $94,923. Okay, so that's the present value of our face value and interest payments combined. Okay, so now what does that mean? So that means we're gonna sell a bond to the public for $100,000, but because the purchaser of the bond can go out into the market and earn 10% interest when we can only pay 8%, we're gonna sell them a $100,000 bond for only $94,923. Okay, and in the end, we're gonna pay them back $100,000 at the end of that at the end of the 3 years or 6 interest payments, and we're also gonna pay them $4,000 a month, or sorry, $4,000 every 6 months. Okay, so now that we got the present value, we know what we're gonna sell our bond for. So the next step would be to issue the bond, or to record the issuance of the bond. So we're gonna record it at a discount. Again, a discount is when the bond value is less than the market, okay? So what we wanna do is we're gonna sell it for cash. Debit cash for $94,923, okay? We're gonna debit our discount on bond payable for $5,077. Notice $94,923 plus $5,077 equals $100,000. That $100,000 is our bond payable. Okay, so that sets up our entry to record the issuance of the bond. Now, we're paying this bond every 6 months. Okay. So as a result, journal entry number 1. Journal entry number 2 will be the payment of our interest, okay? So 6 months later, now what happens? Well, 6 months later, again, we're gonna use the effective interest method, okay? So if we go back to our textbook, okay, on page 932, okay? Page 932. So we're using the effective interest method. So that method allocates bond interest over the life of the bonds in a way that yields a constant rate of interest, okay? So this constant rate of interest is at the market rate at the date of issue, okay? So the market rate at the date of issue, again, was 10%. Now, we pay on a semi-annual basis, so we got to convert that 10%, divide by 2, we're going to use 5%. Now the next step is, well, how do we make our journal entry to record the payment of interest? Okay. Well, what we do then is, look at your table on page 932. Okay. So notice we have 1, 2, 3, 4, 5 columns. Okay. So on the date of issuance, notice our column E, the carrying value is $94,923. The unamortized discount is $5,077. Okay. So now we've got to make our interest payment. Our interest payment is going to be on June 30th, 2021. Okay. So we look at the bond. Now the bondholder knows they're always going to get $4,000 of interest. Okay. Because that's what's attached to the bond. The bond says you're going to get it's going to pay 8% interest semi-annually, so that's 4%, which is $4,000. Okay, so that's not the interest expense. That's only the cash payment for interest. Okay, so what we've got to do is we've got to say, okay, well, we know our cash paid every 6 months is going to be $4,000. Well, now what? Okay, well, what's the interest expense? Okay, well, the interest expense is going to be $94,923 times the semi-annual market rate of 5%. Okay, that is going to give us $4,746. Okay, so what's my journal entry? Debit interest expense. $4,746. Okay, I'm going to credit my discount on bond payable, $746, and I'm going to credit cash because that's the cash that I'm paying out to my bondholders of $4,000. Okay, and I keep repeating this entry, albeit with different numbers, 5 more times, because once I make that entry 6 times, okay, the term of the bond is done. Okay, so notice on this effective interest amortization table, the period interest expense increases every 6 months. Why? Because if you go look at the carrying value, it's increasing by the amount of the discount on the bond premium. Okay, or sorry, the bond payable. Okay. So, for example, if we wanted to make that journal entry for December 31st, 2022, how do we do that? Well, that would be our 4th payment. Interest expense is $4,864. Okay. The discount on the bond payable is, in this case here, is now $864. And our cash payment is $4,000. Okay, so our very last entry would be the entry to retire this bond. So after we make our 6 interest payments, the very last entry would be debit bond payable, $100,000, credit cash, $100,000. Now the reason for that is because we want to retire the bond and pay the cash back that we actually borrowed. Okay, so you can see here, to make this effective interest amortization table, okay, you can just follow the methods, right? Because you're figuring out your next period's interest expense by multiplying the semi-annual market rate times the ending carrying value of the prior period. And you're just working your way, you're amortizing the discount down to 0, and you're working your carrying value from $94,923 up to $100,000. So every time we make this entry here and this entry here, it's adding to the discount on bond pay, or sorry, the carrying value of the bond. Okay, so eventually we're going to work our way up to 100, and that's this here. Okay. All right, now if we were to do this as a premium on bond payable, it's exactly the same way. The only difference is now we're going to go to page 934. Now the only difference is that the bond rate would be higher than the market rate. So as a result, the bond would sell for more than the face value of $100,000, rather than when we sell at a discount, we sell it at less than $100,000. But the mechanism is the same way. And you'll see that on page 934 and 935. Okay. So I'm going to assign a couple questions, okay, dealing with bond premiums and bond discounts, okay. I'd like you to attempt to do those questions, and on Tuesday we'll go over one on the board here and keep going on with chapter 14 dealing with bonds. Okay. All right, that is it for today. If you have any questions, please let me know. Also, make sure you please, for anyone who has not yet handed in their midterm exam, please hand that in. Okay. And again, just a reminder, this topic is on the exam. I almost always use the discount method on the exam, so make sure you can calculate the sales price of the bond, okay, using the present value tables, and make sure you can make your journal entries. The first journal entry is always important because that establishes the selling of the bond. You want to make sure you know how to make your last entry, which is your retirement of the bond, because you're paying it back now. And you need to know how to calculate your interest payments. That you're going to be able to do by creating your amortization table, which is also a requirement of the exam. All right, so that's it for today. We will be in touch. And again, if you have any questions, please email me. And reminder to everybody, please make sure you email me on a daily basis. That's the only way I can give you credit for your attendance. Unfortunately, I know sometimes it's kind of a pain, but we got to do what we got to do. All right, so that is it for today, and we will see you tomorrow.